Good morning or good afternoon to everybody. Welcome to everyone who's watching and listening from wherever you're joining us from around the world. We may all be in different locations, but I think what unites us in being here is our common interest in digital assets and cryptocurrencies, and in particular, how the institutional space is maturing to incorporate this emerging asset class. My name's Helen Disney. I'm the founder of Unblocked, and it's been my great pleasure to work with Coinscrum over the last few months to put together this fabulous program of speakers. And also to be here today to listen to what they have to say. To open our event formally, we're delighted to introduce a fireside chat, which is going to be hosted by Lawrence Wintermeyer. I'm sure many of you know him already as the Executive Co-Chair of Global Digital Finance, who are one of the event partners today and a leader in advocating and accelerating the adoption of best practices for digital assets. We're really excited that Lawrence is going to be in conversation with Chris Tyrer, who's head of Fidelity Digital Assets Europe. They've just recently brought out a report which some of you might have seen. We're going to be talking about the highlights from that report, among many other things. Apologies from Lawrence himself that he wasn't actually able to be here today due to personal reasons. So this is a pre-recorded interview that we managed to do at the very last minute. So we're very grateful to Lawrence and Chris for making that happen. There will be opportunity to do live Q&A for all of the rest of our panels, which are all live. So without further ado, I hope you enjoy this opening discussion on lessons from history and the natural evolution of the crypto market infrastructure.
Thank you, Helen. Welcome to Lessons from History and the Natural Evolution of Market Infrastructure. I am Lawrence Wintermeyer, the Executive Chair of Global Digital Finance, and I'm delighted to be joined by Chris Tyrer, Head of Fidelity Digital Assets Europe and Fidelity Digital Assets. Chris, welcome.
Thanks for having me.
Absolute pleasure. Now, you and I were chatting about this, and we think we've seen this movie before in other markets, whether that's the FX or commodities markets 20 years ago, increasingly automated, again, driven by deregulation and technologically innovation-led, opened up price discovery transparency. So give us an idea of what you went through at that time and how you are seeing the crypto and digital asset sector evolve.
Yeah, so I really see a very strong analogy to the commodities markets of 20 years ago. And for some background, I got into digital assets in 2017. That's when I started working on it full time. But prior to 2017, I'd spent 17 years working as a commodities trader. In my last role, I was the head of commodities trading at Barclays Investment Bank. And so I lived through that period and sort of remember it very viscerally. And back then, sort of late 90s, early 2000s, the commodities markets were effectively corporate hedging markets. There were producers who were selling a proportion of their forward supply in order to lock in some of their revenue, and you had consumers who were buying some of their forward demand in order to lock in some of their expense base. And there was no real institutional investor interest. We had a couple of investment banks involved, but they were really just directing traffic. And a number of things happened which changed all that. But I think it's worth, again, just digging into some of the historical background, because I think that the parallels to digital assets today are really very clear. And the first thing to say is that we were coming on the back of this sort of deregulatory trend that we'd seen, and that started in the 1980s and the 1990s. And this was a fairly significant deregulation of financial and commodities markets. In the UK, we refer to this as the Big Bang, and that really sort of set the UK up to be a center of global finance, for the next 20 to 30 years. And as a result of this deregulation, we started to see investment banking explode as an industry. And in turn, this prompted, I would say, fairly significant financial innovation and really improved the product suite for most asset classes. And in the commodity space, we had the GSCI, which is the Goldman Sachs Commodities Index, that was created in 1991. And soon after, as a financial institution, you were able to trade the Goldman Sachs Commodities Index as a swap. Now, up until this point in time, anybody who wanted broad-based commodities price exposure had to trade multiple products on multiple exchanges, in multiple time zones, in multiple legal jurisdictions with multiple settlements throughout the month. And bear in mind that these are physically settled contracts as well. And so the operational burden and risk involved with accessing this market in a broad-based fashion was just, it was too much for most institutional investors. And so what the Goldman Sachs Commodities Index did is it effectively created commodities price exposure as a service. And so at the same time, we had this improvement in the commodities infrastructure. And so through the late 90s, predominantly, most exchanges and most assets were traded by open outcry and by voice-broked OTC trades. And in 2001, a small emerging tech company called the Intercontinental Exchange acquired the IPE, the International Petroleum Exchange. And so they started launching side-by-side trading, so screen trading alongside open outcry. And then in 2005, they closed the pit, and it just now is being screen-based ever since. And what this did is it democratized the access to market data, and it removed a lot of the data asymmetries and information asymmetries that had existed up until that point in time. And again, this is very significant for institutional adoption. And then one of the other things that was relevant is, just in terms of portfolio allocation, a lot of people at that time, and I remember the conversations, a lot of people really didn't consider that commodities were a true asset class. And this, again, is a conversation that we're having now about digital assets, and we'll come on to that side of the equation. But this was a conversation as the liquidity was starting to come in and as this interest was starting to come in, are commodities a true asset class in and of themselves? And at the time, we were, the early 2000s, we were coming off a multi-year bear market in equities following the bursting of the tech bubble. And investors were increasingly open to finding returns from alternative sources. And you can see this in the CAIA association data. And that had allocation to alternatives as a percentage of global investable assets at 6% in 2003. That's 12% by 2018. And so there was this appetite to source return and yield from elsewhere. So in summary, we had improved market access, we had improved market infrastructure, we had increased transparency, we have development of investable products, and we also had an appetite to seek alternative investment opportunities from the institutional investor community. And at that time, we within the commodity space specifically, we had this incredible investment case. And so just in terms of the diversification properties of commodities themselves, it's modern portfolio theory 101. The introduction of an uncorrelated asset into a diversified portfolio increases the risk-adjusted returns. Harry Markowitz famously said that diversification was the only free lunch in investing, and that very much holds true. And we also had, though, positive expected return from any kind of long-term allocation to commodities. And this is owing to the market infrastructure. So a healthy commodities market is typically in backwardation. And what this means is that the prompt contracts are more expensive than the deferred contracts. And naturally, through holding these positions, you effectively have your price exposure in a prompt futures contract. And periodically, you will need to sell that contract and buy something more deferred. And as you do so, you're effectively capturing the difference in price. And this, at that point in time was positive. And as I say, healthy commodities markets are generally in backwardation. And so just a passive exposure, even without any price appreciation in and of itself, should yield somewhere between 5 and 8% at that point. And then you had the case for price appreciation itself. And so in 2000, the CCP, the Chinese Communist Party, they issued their 10th five-year plan. Now, these five-year plans are social and economic development objectives that they've been announcing since 1953. And so one of the things that they were looking to achieve from the period of 2001 to 2005 was to increase the number of urban employees by 40 million. Now, this is equivalent to the whole of Germany's workforce at that point in time. And so you required this huge increase in industrial and social infrastructure. You needed factories, power stations, roads, housing, hospitals, schools, everything. And this was going to create this huge demand for raw materials if they were going to achieve this in a 5-year period. And so you had this trifecta of reasons to allocate to commodities just as the market was opening up. And this, as a result, caused huge inflows from the institutional investor community. And so we saw allocations from commodities go effectively from zero in 2002 to nearly 400 billion by 2010. And the funny thing to me is that we're having a lot of we're having a lot of the same conversations in digital assets today as we were back then. A lot of people are questioning, are digital assets an investable asset class? We have this developing product suite. We now have ETNs in Europe. We have ETFs in Canada. We have numerous private funds that can give price exposure in a familiar wrapper, including Fidelity's own Wise Origin product. We have an improving regulatory environment. Last year, we had 2 guidance letters from the OCC. We also had the release in September of MiCA, the Markets in Crypto Assets, which is the draft regulatory framework put out by the European Commission. And there seems to be generally a desire to regulate and provide clarity as opposed to ban. It's helpful regulation. The irony here and one of the sort of key differences for me is that it's actually an increase in regulation that is going to open these markets up to more institutions. Back in the 80s and 90s, we definitely saw that it was a decrease in regulation. And I think that really is just owing to the fines that were levied against a lot of the large-scale financial intermediaries in the aftermath of the global financial crisis. Now, operating inside the regulatory perimeter is definitely preferred. And so that is one of the key differences. But we've seen a massive improvement in market access and infrastructure. Just from a retail perspective, we've had PayPal, Square, Venmo, Revolut, all open channels to crypto. On the institutional side, we have real true institutional custody providers. I would say that Fidelity blazed the trail here, announcing our own solution in 2018. And in addition, we've got a significantly improved exchange and liquidity infrastructure. We now have dedicated institutional venues such as LMAX. TICAP is launching their institutional venue later this year, which we will be supporting. We have multiple banks now supporting the CME futures. We have deep borrowing and lending markets. We have proper research, proper market data, proper blockchain data. And looking back 5 years ago, none of this existed in the digital asset space. And at the same time, there is I believe, a significant investment case for digital assets. I think it's beyond the scope of this chat today to go into that in too much detail, but just mapping it back to the commodities case that we laid out just earlier, digital assets they have very little correlation to traditional financial assets. With the development of borrowing and lending markets, but then also with the introduction of more proof of stake assets, we can expect a positive return from a passive exposure to these assets in a lot of instances also. And then there's the case for price appreciation. And, we've obviously seen massive adoption thus far. We've seen massive user growth. A lot of the investors that we speak to think that if that persists, some of the returns that we've seen historically could persist into the future also. And so, again, for me, the conclusion of all this is that we see strikingly similar environments between the digital asset situation today and that of commodities just 20 years ago. And so if those similarities persist, we really could be on the precipice of really some very, very significant institutional investor inflows.
Well, that was just one of the most excellent counters through an era we've seen before and how it relates to crypto and digital assets. And I think in bagging your trifecta, the biggest difference that you've highlighted is that 20 years ago, we were deregulating markets, which was certainly driving adoption, and in this case, institutional led for all sorts of reasons, whether it was correlation, hedging, many of the reasons that you've mentioned, driven by innovation, technology, and the transformation of what were older OpenCry, markets. But if we look at the FI or financial institutions adopting crypto, in particularly across, brokerage, custody, and settlement, and we look at the immediate period now for the next 36 to 60 months, what is missing to drive that greater adoption right now, and what are the two or three big priorities that you see FIs have on their program run book to really make sure that they're driving the adoption of crypto and digital for not just retail customers, but for their corporate and wholesale customers?
Yeah, it's a great question. I think it largely comes down to something we touched on before, but it's the regulatory clarity. Like, I think that we're now in a world where heavily regulated financial institutions and the big intermediaries really need to see that perfect regulatory clarity. They need to understand, how is this asset treated? Is it a commodity? Is it a security? What is how is the custody, the provision of liquidity? How is that? How is that regulated? Is it regulated at all? And I think that once we have that, and I think that again, we're starting to see very positive trends in this direction. And I think that the draft framework that's coming out of the EU, I think is going to be transformational in terms of how large-scale financial intermediaries interact with this asset class. So it's our expectation that once that comes into force, and we expect that to happen sometime in late 23, early 24, that we could see significant more adoption or the provision of services from some of the large-scale banks. And I think that's if you're a hedge fund right now, you have you work with a handful of prime brokers. You might be able to get price exposure through CME futures. We all know that the CME futures, whilst they track the price of Bitcoin very well, owing to the term structure, they're not very efficient vehicles for holding long-term positions to digital assets. And that's how a lot of the investors that we speak to are really viewing this asset class. It's buy and hold. And so I think really the once we start to see some of the larger banks providing services, and in that way a hedge fund can access this marketplace through their existing channels, I think that's going to be the next step. Right now, this infrastructure is developed incredibly well, but it sits outside of the traditional mainstream financial channels and platforms.
Well, Chris Tyrer, it's been an absolute pleasure listening to you. We're going to have to reconvene again at another time in a forum and carry on this dialogue. I think the point you make should not be lost on the crypto and digital asset sector, which is FIs coming in and helping to get regulators comfortable, particularly with standards across brokerage, custody, and settlement to meet FI governance models is what really is going to drive significant adoption across all markets. So let's wrap up on that. I'm Lawrence Wintermeyer, the Executive Chair of Global Digital Finance. Thanks, Chris, and I'll hand you back to the Coinscrum team.
Thanks very much indeed.
Thanks, Lawrence and Chris. Some fascinating insights there. We'll be starting our next panel shortly, so if you'd like to select agenda at the top navigation bar, and you'll be able to join the next panel.